Hi guys, welcome back to How to Learn Fundamentals series. So today we're going to be talking about central banks. What do they do? What their role is and what to look out for and how to actually apply it to your trading of the markets. So today we are in London, my city, and we're going to be actually going outside the Bank of England, the BOE. So come on, let's get on with this series. So guys, we're outside the Bank of England, the central bank of the UK, the United Kingdom, currently governed by Mr. Mark Carney, aka the unreliable boyfriend. Now he's been given that name by the media because there's a number of occasions where the markets have been listening to his guidance on future monetary policy actions by the central bank. However, not fulfilling that guidance that he's given, hence the name unreliable boyfriend. So what does the central bank do? Well, they're in control of the economy's or a country's monetary policy. So essentially they dictate the growth and rate of money supply, so flow of money into an economy, which in turn affects interest rates. Now remember the last episode we spoke about interest rates? Well, it is the reward to lend, the cost to borrow, and the reward to also save money. Interest rates. What happens when they go up and when they come down? So when a respective central bank, e.g. the Bank of England, raise rates, that's done in order to slow growth down and also cool inflation, so prices rising, slow that rate down. But when they cut interest rates, that's done in order to try and spur some growth and thus bringing up levels of inflation and prices. When you do have a respective interest rate decision, you need to keep an eye on particular comments around monetary policy to get an understanding of what they're going to be doing next, because that is key in terms of how what will happen to the markets. Also listen out for commentary on inflation, labour market, and also wages. So all of these things you need to focus on at the respective central bank decisions, but also when they're commenting outside of rate decisions. It's important that you familiarise yourself with the voting members. Each respective key central bank has members in which vote and they influence the decisions on future monetary policy. So in terms of all of those central banks then, they all have websites. So you can go there and check who the members are, but more importantly, which ones are voting. Now they do have voting rate cycles, which they do change who's a voting member and who's a non-voting member. So that does change depending on the central bank's cycle. From the members, you will also note that they have respective stances, whether they're a hawk or a dove. Now I'll go through that in more detail shortly. But from the website, you'll also be able to see the central bank's previous monetary policy statements, upcoming events, but also when their members are scheduled to speak. That way, you do not get caught off guard with certain market moves. So guys, we're just on a lookout for hawks and doves. Oh, there's a hawk, there's one. So guys, someone with a hawkish stance is thinking about keeping inflation low. So how do they do that? Higher interest rates, no QE, no stimulus, a tighter monetary policy. And let's look out for a dove. Oh, there's one, there's a dove. Okay, so someone with a dovish stance is always keeping in their minds about improving employment and labour market. So lower interest rates, stimulus, quantitative easing, pumping money into the markets, bond buying, all of these things. And that's loose monetary policy, where in comparison, as I just mentioned, a hawk is tighter monetary policy. If you type into Google, you can bring up a scale of hawks and doves. So type in ECB hawks and doves, Fed hawks and doves, Bank of England hawks and doves, and check on the scale which voting member has which stance. And for example, this is what I said, you need to know your members, because say for example, a dovish voting member says something that's slightly hawkish, that's really going to have a larger impact on the markets. Fortunately, we've just seen a rate decision, the Bank of England on just the Thursday gone. And the result, we saw a large amount of strength across the board for GBP. Now I'm going to show you the chart, I'll break it down for you in a moment. But look, have a look from the actual rate decision at 12 o'clock London time. we gained like around over 180 pips to the highs there. Some big moves. Now, as I mentioned before about voting members, they vote on future monetary policy and how interest rates should go. And if we look at the actual rates vote, previously we saw 7 members looking to keep rates unchanged, where 2 were calling for a hike. But this time round, the late decision, 6 members were saying unchanged on interest rates, but 3 this time, 1 extra member calling for a hike, so pushing the Bank of England closer to raising interest rates. Now, why does this strengthen a respective currency? Because it makes it more attractive, more foreign investment coming in to the respective economy, thus strengthening a respective currency. Whereas if rates are low, from an investor's perspective, in looking at another nation or an economy, you know, because you're getting less return, it makes it less attractive. So that's why you would see a respective currency weakening when a central bank is lowering rates, or if they're pumping money into the markets and diluting a currency, is weakening. Whereas raising rates and being more hawkish strengthens a currency. So guys, just to wrap up then, remember we spoke about the central bank's role. They're in control of monetary policy. So the growth and the rate of money supply, flow of money into the economy, which affects interest rates. Voting members, you need to familiarise yourself. Make sure you're going on each respective central bank's website and checking out who the voting members are for each cycle. And then also hawks and doves, which we discussed. Remember we were looking out for those? A hawk is someone that wants to keep inflation low. So higher interest rates, no QE. A dove is always thinking about improving employment in the economy. So, you know, lower interest rates, quantitative easing, bond buying. And then lastly, the impact of a currency. If you naturally think higher interest rates strengthens a currency, low interest rates and quantitative easing weakens a currency. So I hope that's given you a good insight initially into central banks' role and how they can impact the markets. Thank you very much for tuning in again. Please guys, if you are enjoying this series, make sure you support, hit that subscribe button like you would hit buy and sell with your trades, and continue to support the Freaky movement. Thank you very much. I am KenFX Freak.